battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 44 years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Welcome back to the show, episode 181, Why I Sold All My Stocks. We're going to talk about that in a second. It's not what you think, so don't go hit the panic button and sell right now until you at least listen to the rest of the episode. But before we jump into today's content, I want to remind you about the two events we've got coming up this year. We've got our Wealth Insights Forum in Houston in just a few weeks. We're basically at max capacity here, but if you are still a last-minute reservation and you'd like to come, you've been thinking about it, you just forgot to register over the weekend, we did get the 10 people over the weekend to register that we were talking about that would officially fill the event. So we are technically at max capacity, but if you are wanting to come, let's see what we can do. We might be able to get you on for Saturday. I think Friday's completely sold out. It's going to be one of our biggest and best events we've ever done, 4 seasons in Houston, and then we're going to follow that up in October, the 16th and 17th at Gibson's at Oak Brook here, and you can't miss that thing. We got 3 guest speakers, and you do not want to miss Investor Day as always. So let's talk about the market. Let's talk about this week's episode, Why I Sold My Stocks. Market today is right at the 5,100 point level as we're recording the show. It's a Monday. So depending on when you watch this, we're going to be hovering hopefully between 5,000, maybe 5,200 points. And that's not that bad. And if you look at the S&P from its all-time peak here, we ran up to 6,150. We told you that's probably a little bit too fast. We did the crystal ball episode. I had the crystal ball sitting on the table. You can go fact check me on this. And I said, we're going to ultimately go up, but not before we have a correction. Had a correction a little bit faster than I thought, a little bit sharper than I thought, but it's exactly like we told you. Now, I believe the market's eventually going to go back up here, and I think it's going to go a lot faster than people realize. Maybe not in the next 2 weeks, maybe not in the next 2 months, but the average correction start to finish to break even with reinvested dividends over the past 150, 200 years has been 22 months. So as we sit here today, I'm not telling you this is the best buying opportunity of all time. I'm not saying that you've never had a better buying opportunity, that this is a generational buying opportunity. I'm not saying anything like that. But I believe if you are in today or you've just stayed invested, let not your heart be troubled. Do not panic. Don't go jump off your ranch house and break your leg. You are going to be okay. The market is going to go back up. So stay on your plan. Do not panic. Don't run for the hills. Don't build I had somebody text me the other day, what are we going to do? The world's coming to an end. What do I buy? Everything is down. And I said, well, your worst case scenario is you build a bunker in your backyard and fill it with canned food and cassette tapes. Don't do that yet. I don't think you need to do that. So market is going to go back up. It's just a matter of when, not if, just like the market corrected. We told you it's not a matter of if, it was a matter of when. Now, we have been getting some emails, some calls from clients, and it's actually more volume inbound panicking than it was during COVID. So we've lived through this a bunch of times now. In recent history, it was 2022. Market was down 25%. The media didn't tell you to have a panic attack and have a meltdown, so you didn't. Market was down 25%, okay? So if just in case you have short-term memory and you forgot 2022, guess what? There were no tariffs at the time. The Fed was doing its tightening cycle. Market was down 25% in 2022. So drill that into your memory. 2020, we had COVID. Okay, 2020, we were down 30% in 2 weeks. We recovered. We were up 18, 20% for the year at the end of 2020, despite a global pandemic where we shut down the entire world. So just put these things in perspective. 2018, we had another tightening cycle. The S&P was down 15% during the year, and then it came back. We were only down 4% at the end of 2018. 2011, we had a tightening cycle. You all know about '08 and '09, so everybody remembers '08 and '09 like it was yesterday. Market was down 60% at its absolute worst point, and it still recovered every single penny of its losses. So what in the heck are you doing now? Calling, emailing, saying, Nick, the sky is falling. You got to get me out. You're absolutely, that would be the dumbest possible decision that you could make. Do not sell. Do not panic. Don't get off your plan. I'm happy to take the emails. I'm happy to take the calls. That's what we're here for. So if you really are worried, if you really are nervous, I will tell you the same thing I'm telling you right now. Stay on your plan. Now, some of you have said, Nick, how come you guys didn't do anything? I understand human nature is to scream, don't just stand there, do something. Warren Buffett taught us the exact opposite. Warren Buffett taught us don't just stand there, do something. So the idea that we are going to try and time the market, get you into treasuries, avoid the correction, get you back into the market at the absolute bottom, short the tops, and buy in at every low and fold them and hold them and know when to walk away and know when to run is absolutely absurd. You are not going to be able to do that. That's market timing. That is not what Stenger Family Office does. We are not traders. We are not timers. We are not here to tell you when to get in and when to get out. We are here to make sure your long-term plan works, and that long-term plan is based on data, math, statistics, not based on feelings, based on fact. The fact is, over 200 years of market history, the market has gone up, S&P 500, 10% per year. So what in the heck are you worried about? The average correction only lasts the worst bear markets last 22 months on average. So even if you are 80 years old, some of your money should be in equities. And that gets into the weekly title of the show, which is why I sold my stocks. Now, I'm going to tell you what I did in January. I have really two major taxable investment accounts outside of my IRAs and 401ks. My IRAs and 401ks are 100% invested in the top 50 U.S. companies, just like we do for clients. I have not touched those. I have not bought. I have not sold. I've only bought. In fact, I took my personal 401k at Stenger Family Office. I maxed it out to the 50% contribution on purpose for the last 2 months now, and tried to get my contributions completely maxed out so that I was buying it at a low point. And I've told some of you that you could do the same. So 401ks, IRAs, at least for me, have been 100% equities. That will not change. Buy. Why? Because I'm not going to be touching that money until I'm in my 60s. And if you aren't going to be touching that money until your 60s, do not panic. Do not trade your 401k. Do not get into this nonsense of trying to buy and sell and get in and get out. It is a terrible, horrible idea. Now, in my two joint brokerage accounts, my main two accounts that I run, my one account is my longer term investment account where I just like to have liquidity. I don't necessarily want that money tied up for retirement. That account, I have not done anything. I've done some little bit of adding here or there with some of the cash I've had, but I have not done anything with that account. It's rode up the highs. It's rode down some of the lows. I'm right there with you. But my other joint account is somewhat of a reserves account where I invest it throughout the year, but then right before I have to go pay my taxes, I usually pay my taxes in April, and don't pay throughout the year. I wait till April. I pay in April. That account, I put 100% in cash in January, not because I thought the market was going to go down, not because I really have a crystal ball and I know what the future holds, but because I knew that I had to make my tax payment in April. So I said, we're not going to risk our safe money that I need specifically for my reserves, that I need specifically to pay that tax bill in April. That's the point of this show. So what I did not mention last episode, which I want to talk about today, is how important it is that you would have a goals-based financial plan, because you should not be ever risking your money that you're going to need inside that 22-month window. If you're going to need money in 12 months from today, I would say you probably should have it safer and more secure. Now, at today's point in the market, you could make the opposite case, which I could buy into, that today is such a great potential buying opportunity. Maybe the money that I need in 12 months, I would allocate some of it to the market. That's fine. I think we could all agree on that. But when the market was at all-time highs, why in the world were you, if you were doing this, why would you be risking your safer money that you need for specific goals? And same thing with retirees. We've said this in your financial plan. If you have $1 million, just keep it real easy math, and you're going to spend roughly $50,000 per year, we've said keep about 3 to 5 years of that $50,000 safe and secure in U.S. treasuries that don't fluctuate. So most of you would have gone into this correction with an 80% equity, 20% treasury mix. And that's most of our Stenger Family Office clients. You're in between 15% treasuries if you're retired, all the way up to 30% if you're a little bit more, if you're spending a little bit more towards the later years. But outside of that 15 to 30% you have in treasuries, why would you ever, ever, ever try and time that part of the portfolio? It's such a terrible idea because, again, after that 22-month window on average passes, market is going to be up. Now, how do I know that with such certainty? I don't really know if 22 months from now the market's going to be up, but I'm telling you what the data mass statistics say. And not feelings, not what we think is going to happen with tariffs, not what we like or don't like about Donald Trump, nothing to do with the Congress or elections or anything like that. Simply off the math of the market. And if you are making decisions in the portfolio other than that through that lens, you are putting your family's future at risk. And I'm going to give you a couple examples. I had a gentleman who came to us about a year ago now, maybe a year and a half ago. He initially said that he had made so many mistakes investing. He had tried to time the market. He had tried to get in and get out. And he just was so happy to find a fiduciary financial advisor like us who could allocate his resources. So came in with about $1 million. Now, keep in mind, this is after sitting in cash for probably 6 or 7 years is my guess. I believe that's what it was. He was probably missed out on the best bull market of all time. Okay. So he comes in asking for help. And I said, I'll help you with the one stipulation, like I tell all of our clients, that you listen to the advice that I give you, that you do not have a panic attack as soon as the market goes down. He says, I pinky promise. I totally agree. I need somebody to help me with this so I don't add emotion into the mix. Well, sure enough, market goes down like 1.5%, has a panic attack, must be sold out of the market, and wants to go to all cash. I get a text from him the other day. And by the way, that was probably when the S&P was around 5,600 points. Remember, today it's around 5,100. I get a text from him the other day. He says, Nick, I was right. You were wrong. You thought it was a good time to go into the market. I said it was not. And I was right. You were wrong. Well, in the short term, he's right. Yes, the market is lower today than it is at 5,600 points. But again, that's because he chose to sit out the best bull market of all time and buy in at that time at the all-time peak. So there's no problem doing that. Most of us in our 401k, we buy in throughout the years at the all-time highs, but we have this thing called patience and perspective, and we wait 2 years, we wait 3 years, we look back over 5 years, and it's a rounding error. The current correction is a rounding error in the course of a long-term financial plan. Even if you're 60 years old, like this gentleman was, and you're getting ready to retire in the next 5 years, I would still tell you, you have a long enough time horizon to be mostly equities for the next at least 3 of the 5 years. So why in the world does it matter if you bought in at 5,600 or 5,500 or 6,000? It doesn't matter because you're on a long-term plan. And even the day you retire, let's say you're 60 years old, you retire at 65. You say, well, now I definitely got to get conservative. Don't I have to go to mostly treasuries, mostly bonds when I'm 65? I've heard that I need to get very conservative. Well, what happens if you're going to be around until you're 85? You have a 20-year retirement. What happens if you're around till 90 or 95? Even beyond 95, what happens if you want to pass the money to kids or even grandkids? How in the world are you going to justify going to 100% bonds or a majority bonds that cannot beat inflation over time? Structurally, most of these asset classes outside of U.S. large cap equities will be able to beat inflation. So that's your big risk. As you think about what's my risk long-term in retirement, it is not these market corrections. It's not these 20% drawdowns. It's not the 15% drawdowns. It's not the 08 and 09 60% drawdowns. Your biggest risk is inflation. So the price you have to pay to own equities, which are the best asset class on earth, is volatility. This right now is volatility, and volatility is always going to be with us. Warren Buffett had a phenomenal video. You can look it up on YouTube. It's been going around on social media lately. And he said some people just shouldn't own equities. If you aren't prepared for a 20% correction, don't be in the equity market. Be in the bond market. And you can see what happens to people long term when they're in too many bonds. You can see what happens to people if they're in too many treasuries or too much cash or too many gold bars. That is the biggest and worst risk that you can take, is going into the equity market if you just can't handle it. Do not be in equities if you don't understand how equities work. So remember the example of Mr. Market. This is from Ben Graham, Warren Buffett's mentor. Mr. Market is the guy who walks past your house every day. He looks at your house and yells out a random price. Now, let's just pretend you paid $400,000 for your house. One day he walks past and he says $350,000. The next day he walks past, he says $450,000. Another day he walks past and says $250,000. Are you going to listen to Mr. Market and sell him your $400,000 house at $250,000? Absolutely not. Why would you do that? You would never do that. You'd never do that with real estate, never do that with any asset that you own. But for some reason, when it comes to equities, when it comes to stocks, when Mr. Market yells out that random price to you, for some reason you entertain the possibility that you would sell your ownership. That's what stocks are. They're a claim on real assets, that you would sell that to him at a ridiculous price. So, if the grocery store is open, if you wake up in the morning and you can go into Jewel Osco here in Illinois, or you can go into H-E-B in Houston, or you can go wherever, Walmart, Aldi, wherever it is that you shop. If you can walk in and buy groceries that day, guess what? The economy is still working. The economy is still on. And if the economy is still working and functioning, stocks are not going to zero. Stocks are not going to be companies are not all going to be out of business. Now, out of a portfolio of 100 companies or 50 companies or however many you want to own, we like the top 50 to 60, there's going to be one or two that are not going to make it 10, 15, 20 years down the road. That's absolutely a reality, but that's why you're not 100% in one company. But if you can go shopping at the grocery store and you can buy food for your family, there's a good chance the world is going to be okay. The world is not coming to an end. So I will tell you this one last time today, and I'll say it as many times as I have to. If you want to talk individually, have a call, do an email, whatever it is. But I'm going to tell you the exact same thing. Do not panic. This is going to pass. The market is going to go back up. We are going to make all-time highs. I don't know the timeline. I don't know what the future holds. None of us know what tomorrow has in store. But statistics, math, the data is in our favor. Turn off the nonsense, turn off the noise, take the TV remote and go watch something else. My wife and I, when these corrections happen, we're sitting at home. Instead of watching TV, instead of watching the news, we'll watch comedians in cars getting coffee. Okay, pick something else. Turn off the nonsense. Go outside, take your dog for a walk, do something else. And when you wake up a year from now, 2 years from now, 3 years from now, I can tell you with a high degree of certainty, markets will have recovered, and you will be so happy you did not panic. Now, I'm going to leave you with one other story. We lost one person to the Bears this week. We lost one jumper at Stenger Family Office. We have about 600 clients. One actually took the bait and jumped off their plan. One. So if you want to be that one person, okay, remember that this person had been in, stayed in, could have handled all the corrections. They lived through 2022 when the market went down 25%. They lived through COVID when the market went down 30%. They lived through 2018 when the market went down 15%. They even lived through 2008-09 with us when the market was down 60%. But because of this one correction, now, depending on their political leanings, a little bit of fuel was added to the fire, but they jumped off and they took the bait. And you know what they told us? They said, we'll get back in when things get better. Do you think they're ever going to return to the stock market? I will tell you from experience, no, they will never, ever, ever get back on their plan and get back to the markets. So 99.99% of our clients stayed on their plan, did not panic, did not take the bait. Do not be in that one or two people that panic, because you will never, ever be able to be right twice and know when to get back in. It's just impossible. And chances are, if those people do get back in, they're going to buy in at a higher price than at what they sold. So stay on your plan. Do not panic. Keep the faith. Let not your heart be troubled. This will all pass. give me a call personally. My direct line is 630-912-8295. So if you really are nervous, call me, 630-912-8295. Send us an email, come to the events, come see us in person. We're going to have an awesome presentation for you in April. We're going to do the same thing in October. Come back to the show every week. And thank you so much to those of you who have subscribed. Subscribe on YouTube, Apple, and Spotify. We will get through this. We will make new highs. Keep coming back to the show each and every week where we give you the clarity, the confidence, the good news, the reasons why you got to stay on your plan. Thanks for being here. This was episode 181. We'll see you next week, episode 182.